Imagine a world where two of the largest foreign investors in U.S. government debt, Japan and China, are steadily pulling back from a role they once played so crucial to stabilizing the American borrowing market. Today, we dive into a story that has been unfolding over several years, but which has now reached a critical tipping point. In this analysis, we will explore the reasons behind this strategic shift, the historical background of these investment trends, and what these moves mean for the future of the global financial system. Chapter 1. Historical context and the role of U.S. Treasury bonds. For decades, U.S. Treasury securities have been viewed as the backbone of global finance. The United States, burdened by a national debt that has soared past the $34 trillion mark, has long relied on foreign buyers to help keep borrowing costs low. Japan, for instance, was once among the largest buyers of U.S. Treasuries, with holdings reaching as high as $1.167 trillion in 2024. These purchases helped maintain low interest rates on U.S. debt, allowing the country to finance its budget deficits and stimulate economic growth without resorting to expensive borrowing alternatives. Historically, the relationship between Japan and the United States has been characterized by both strategic alliance and economic interdependence. Since the post-World War II era, Japan has functioned not only as a key military ally but also as a major creditor to the United States. The purchase of U.S. debt by Japan was seen as a mutually beneficial arrangement. The U.S. received cheap capital, while Japan earned modest but secure returns. Over time, however, this balance has shifted. With shifting economic landscapes and emerging challenges in its domestic market, Japan's appetite for U.S. bonds has diminished, a trend that is now accelerating. At the same time, China emerged as a dominant force in the global economy, initially following Japan's footsteps by investing its vast export surpluses in U.S. debt. In the past, Chinese holdings in U.S. Treasuries were enormous, with estimates around $1.27 trillion at certain peaks. However, over the last decade, China has systematically reduced its exposure, cutting its U.S. Treasury holdings by nearly 40%, a move that signals a broader strategic recalibration of its financial assets. Chapter 2. Japan's strategic shift, weak yen and domestic priorities. Japan's gradual withdrawal from U.S. debt is not merely a passive response to external market changes. It is a deliberate policy driven by internal economic imperatives. For years, Japan's economy has grappled with persistent deflation, a weak domestic currency, and sluggish growth, as the Bank of Japan, BOJ, pursued policies to maintain negative interest rates at -0.1% in an effort to combat deflation. Japanese investors found that domestic bonds, though modest in yield, were now comparatively more attractive than their U.S. counterparts. Japan's decision to cut back on its investments in U.S. Treasury bonds is part of a broader effort to reduce its dependence on American assets. As Japan began to sell off U.S. debt, it used the proceeds to bolster the yen through currency interventions. For example, in April 2024, one of Japan's largest single-day currency interventions was recorded, when a massive amount of U.S. Treasuries was sold in order to purchase yen. This move was aimed at strengthening the yen, a currency that has long been under pressure, and stabilizing domestic financial conditions. The statistics underscore the gravity of the shift. From being one of the top foreign holders with over $1.29 trillion in U.S. debt in the early part of the decade, Japan's holdings have now been reduced to figures hovering just above $1.06 trillion. As seen in recent data, this reduction is not just a matter of diversification, it is an active repositioning of Japan's financial portfolio, aimed at insulating the country from the vulnerabilities of an over-reliance on U.S. debt. The BOJ's focus on supporting its domestic bond market, while also navigating a weak yen and persistent deflationary pressures, has driven Japanese policymakers to seek better returns closer to home. Chapter 3. China's reduction of U.S. Treasuries, diversification and geopolitical calculations. Parallel to Japan's actions, China has also been trimming its exposure to U.S. Treasuries, albeit for somewhat different reasons. Historically, China invested its enormous trade surpluses in U.S. government debt as a means of recycling its export earnings. However, recent geopolitical and economic developments have prompted Beijing to reconsider this strategy. Data released by the U.S. Treasury Department in December revealed that China's holdings have fallen to around $759 billion, a significant drop from previous highs that reached above $768 billion in the preceding months. China's move to cut back on U.S. debt is multifaceted. On one hand, it is a response to growing concerns over the security of holding such a large amount of U.S. assets in an era marked by heightened geopolitical tensions. Chinese policymakers are increasingly aware that their vast holdings of U.S. debt, while providing stability in the past, could expose the nation to risks if U.S. economic policies shift dramatically. Moreover, as China continues to develop its domestic capital markets and seeks to diversify its foreign exchange reserves, it has begun reallocating its investments into other asset classes, such as gold, alternative sovereign bonds, and even emerging market assets. The strategic diversification is also tied to China's broader objective of reducing its overdependence on the US dollar. Over the past few years, China has been making concerted efforts to internationalize the renminbi and to build up alternative reservoirs of foreign assets. This shift is not only about hedging against potential US policy shifts, but also about asserting greater financial independence in an increasingly multipolar global economy. In doing so, China is gradually transforming from a country that was once seen as merely the world's largest creditor of US debt into a more diversified investor with a portfolio that spans several regions and asset classes. Chapter 4. The impact on the U.S. economy, rising borrowing costs and market volatility. For the United States, the consequences of these shifts could be significant. The U.S. government has long depended on foreign purchases of its debt to finance budget deficits at low interest rates. As Japan and China reduce their holdings, the resulting decrease in demand for U.S. Treasuries could force the government to offer higher yields to attract new buyers. This, in turn, would raise borrowing costs across the economy and could potentially lead to higher interest rates on mortgages, business loans, and consumer credit, with the national debt already at approximately $35.46 trillion. Even a modest increase in interest rates could have far-reaching implications for economic growth and fiscal stability. Furthermore, if other foreign investors follow Japan and China's lead, the cumulative effect could be a significant contraction in foreign demand for U.S. debt. This scenario would exacerbate concerns about the sustainability of U.S. fiscal policies, potentially triggering a cycle of rising interest rates and a depreciating dollar. While some economists argue that the sheer size and liquidity of the U.S. Treasury market will eventually attract new buyers, the short-term impact could be heightened market volatility, which would ripple through financial markets and affect everything from stock prices to currency exchange rates. Recent data adds urgency to these concerns. In December, the overall foreign holdings of U.S. Treasuries fell from $8.633 trillion in November to $8.513 trillion. Even as Japanese holdings dipped from $1.087 trillion to $1.060 trillion. And Chinese holdings dropped from $768.6 billion to $759 billion. These figures, while seemingly incremental, are part of a sustained trend that could herald more pronounced shifts in the coming months. Chapter 5. A look back, U.S.-Japan relations and the evolution of global finance. The dynamic between the United States and Japan has deep historical roots. From the forced opening of Japan in the mid-19th century to the strategic partnership forged in the aftermath of World War II, the relationship between these two nations has always been a blend of cooperation and competition. During the decades of Japan's post-war economic miracle, its investments in U.S. Treasuries were seen as a symbol of its commitment to the American-led global order. Yet as Japan's own economy encountered structural challenges, persistent deflation, an aging population, and domestic bond market reforms, the rationale for investing heavily in U.S. debt diminished. This transformation is reminiscent of past shifts in global finance. For example, during the Nixon shock in the early 1970s, the United States abandoned the gold standard, leading to a period of floating exchange rates and increased market volatility. The dollar depreciated by approximately 15% against the German Deutsche Mark. Just as that moment reshaped global financial markets, the current shift away from U.S. debt by key Asian economies could usher in a new era of financial realignment. The reliance on U.S. Treasuries, once seen as an unassailable pillar of international finance, is now being questioned in the face of evolving economic realities and changing geopolitical landscapes. In parallel, China's role in the global economy has also transformed. once content to invest its enormous trade surpluses in US debt as a safe and reliable store of value. Beijing now sees diversification as a strategic imperative. The gradual reduction in its US Treasury holdings, coupled with efforts to internationalize the renminbi and develop alternative financial instruments, signals a move towards a more multipolar financial system. This evolution is not just about numbers. It reflects a broader desire among emerging economies to assert greater control over their economic destinies and to reduce their exposure to the policy decisions of the United States. Chapter 6. What lies ahead, potential scenarios and global implications. Looking forward, several scenarios could unfold as Japan and China continue to reduce their exposure to US Treasuries. One possibility is that these shifts will force the US government to offer higher yields to attract new investors, leading to a gradual rise in interest rates. This outcome could slow economic growth and increase the cost of servicing the national debt, placing additional pressure on fiscal policy. Higher borrowing costs may also discourage private investment and consumer spending, further dampening economic prospects. Another potential scenario is that the reduction in foreign demand for US debt could lead to a weakening of the US dollar. A depreciating dollar would have mixed consequences. It might boost US exports by making American goods cheaper abroad, but it could also lead to higher import prices and contribute to inflation. In an environment of rising interest rates, these factors could combine to create a challenging economic landscape characterized by slower growth and increased uncertainty. There is also the possibility that Japan and China's actions could catalyze a broader realignment of global financial power. As these nations redirect their investments toward domestic assets and alternative international investments, they may help to spur the development of new financial markets and instruments outside of the US dollar system. Such a shift would have profound implications for the global reserve currency status of the dollar and could pave the way for a more multipolar financial order, one in which power is more evenly distributed among a range of countries rather than concentrated in Washington, D.C. Moreover, the warming of diplomatic and economic ties between Japan and China suggests that regional alliances in Asia may become even more influential in shaping global financial policies. Although historical tensions between these two nations have sometimes led to rivalry and mistrust, recent high-level meetings and collaborative initiatives indicate a growing willingness to work together on issues of mutual interest. This developing cooperation could accelerate efforts to build alternative financial networks that are less dependent on the US-led system, further challenging the long-standing dominance of American financial institutions. In conclusion, the ongoing reduction of US Treasury holdings by Japan and China represents much more than a simple portfolio rebalancing by two major economies. It is a strategic pivot driven by domestic economic challenges, evolving geopolitical considerations, and a broader desire for financial independence. The statistics are clear. Japan's holdings have fallen from around $1.29 trillion to just over $1.06 trillion, while China's have dropped by nearly 40% over the past decade, with recent figures indicating holdings of approximately $759 billion. These shifts have significant implications for the United States. Reduced demand for US Treasuries could force the government to raise yields, increasing borrowing costs and potentially leading to a weaker dollar and greater market volatility. Such outcomes would have ripple effects across the economy, affecting everything from consumer credit to corporate investment decisions. At the same time, the emerging cooperation between Japan and China hints at the possibility of a new regional financial order, one that challenges the traditional dominance of the US dollar and ushers in a more multipolar global economy. As we stand on the cusp of this new era, the question remains, what next? Will the US be able to adapt to a world where its most reliable creditors are no longer as dependent on its debt? Or will these shifts force a fundamental rethinking of fiscal policy, monetary strategy, and global economic governance? These are questions that policymakers, investors, and everyday citizens alike will be watching closely in the coming months and years.